Good morning. Grab your coffee, take a seat, and look around your room for a second. That smartphone on your nightstand, the coffee beans in your mug, even the shoes you're about to put on. There's a 90% chance they all arrived here the same way, on a massive ship crossing a deep blue ocean. For 70 years, we've taken that for granted. We assumed the seas were open, the lanes were safe, and the prices were low. But as of this morning, that world is officially over. The ocean is closing, and it's not because of a storm or a war in the traditional sense. It's because of something much more invisible and much more dangerous to your wallet. The math of risk has finally broken. Here's the deal. In February 2026, a series of simultaneous drone strikes hit 3 major insurance data hubs. It was called Operation Epic Fury. They didn't sink a single ship that day, but they did something much worse. They blew a hole in the actuarial models that run global trade. Suddenly, the War Risk Insurance Premium Index, we call it the WARX, didn't just tick up. It exploded. We're talking about a 2,400% jump in 3 years. 1.25% of the entire hull value, just to move a ship through a gray zone. Let that sink in? For a $200 million vessel, that's $2.5 million just for the permission to exist on the water for a few days. Now look at the Drewry World Container Index. It's sitting at $14,500 per 40-foot container. That's a 480% increase. Why? Because ships are idling at sea, not because of the weather, but because they're legally invisible. If you don't have insurance, you can't enter a port. If you don't have insurance, you're a floating liability that no bank will touch. We're seeing a massive actuarial heart attack unfolding in real time. If the world's oldest insurance markets, like Lloyd's of London, are issuing cancellation notices for 40% of the planet, who is left to hold the bag for your next grocery bill? So let's talk about the real problem. Why can't the smartest guys in London or Zurich just price this risk and move on? That's what they've done for centuries, right? Well, here's where the story takes a turn. Insurance is basically just paying for a prediction. You give them a premium, they bet on the probability that your ship won't get hit. But we've entered the age of gray zone attrition. It's a world of cheap drones, cyber spoofing, and deniable attacks. In January, we saw the Black GPS event, 48 hours, where the South China Sea just disappeared from the map. Every GPS signal was spoofed, every navigation system was screaming. It created what experts call actuarial blindness. If you can't predict the risk, you can't price the premium. And if you can't price the premium, you walk away. That's exactly what's happening. Private capital is fleeing the ocean. Swiss Re and Munich Re have effectively withdrawn coverage for 42% of global sea lanes. This has created a $12 trillion liquidity gap. It's the sound of the global merchant fleet losing its collateral value overnight. Shipping used to be a boring, market-driven industry where the most efficient company won now. It's a high-stakes gamble where the house has stopped taking bets. It's fascinating, really. We're watching the death of probability. When a $1,000 drone can render a $100 million insurance policy void, the math stops working. And when math stops working, economists start sweating. We're not talking about a temporary blockage like the Ever Given in the Suez Canal. We're talking about the permanent erosion of the open seas doctrine. The ocean is becoming uninsurable for the private sector. But in this vacuum of risk, a new and more powerful player has emerged, and honestly, they aren't looking for profit. They're looking for control. Now, this is the part I find wild. When the private markets fail, the state steps in. Enter the Sovereign Risk Guarantee Fund, or the SRGF. We're looking at a brand new asset class worth nearly $5 trillion. The G7 nations and China have realized that if the ships stop, the lights go out. So they've started nationalizing maritime risk. If you're a ship flying a preferred flag or carrying essential cargo, the government treasury is now your insurer. This sounds like a relief, right? Not so fast. Shipping is no longer a service you buy on the open market. It's becoming a diplomatic favor you receive. Look at the data. The market share of sovereign-guaranteed vessels jumped from 12% to 65% in just 1 quarter. We're seeing the rise of state-backed mega-carriers. Think of companies like HOSCO or fleets guaranteed by the U.S. International Development Finance Corporation. They can sail where others can't because they have the deep pockets of a central bank behind them. But there's a catch. If you want that ironclad trade lane protection, you have to play by the state's rules. Trade routes are being divided into 2 categories, ironclad or dead. This is the nationalization of global trade. If you're a small nation or a company without a sovereign big brother, you're effectively priced out of the ocean. You're stuck in the uninsurable zones, watching the state-backed convoys sail past. It's a monopoly on a global scale. Goldman Sachs is calling these SRGF-linked bonds a high-yield, low-volatility miracle for investors, but for the rest of us, it means the end of the competitive shipping market. Is this state takeover a modern necessity? Or are we desperately repeating a strategy from the brink of World War I? Let's zoom out for a second and look at history, because we've been here before. Flashback to 1914. The UK government realized that private insurers were too terrified of German U-boats to cover grain ships. So they created the British War Risks Insurance Scheme. They nationalized 80% of the risk just to keep the country from starving. It worked, but it was supposed to be temporary. The 2026 version, it feels a lot more permanent. The chief risk officer at Lloyd's of London recently warned that this isn't just a glitch, it's the death of merchant capitalism as we know it. When risk is socialized, efficiency dies. When a government guarantees a ship, they don't care if it's the fastest or the cheapest. They care if it's secure. This is what the IMF is calling trade balkanization. We're moving toward a world where the ocean is a series of gated communities. The bulls argue that this is the only way to ensure national security and decouple from fragile private markets. They say it creates ironclad stability. But the bears? They see the 1914 parallel as a warning. Back then, it was a prelude to total war and the collapse of the first era of globalization. Think about that. We're using a 100-year-old emergency playbook to manage a 21st century cyber war. The similarity index between 1914 and 2026 is sitting at a staggering 88%. But back then, they were fighting battleships. Today, we're fighting actuarial blindness caused by invisible drones. The gates are closing, the state is taking the wheel, and every single one of us is about to receive the bill for this new secured ocean. All right, let's bring this home to your wallet. I know maritime insurance sounds like something that only matters to guys in suits in London. But here's the number that should keep you awake, 19.8%. That is the average security tax surcharge now being slapped onto every CIF import. It's not a one-time fee. It's a permanent surcharge on every physical object in your life. That coffee, 20% more. That new car, 20% more. Your 401 kil and your savings haven't moved an inch, but their ability to buy the world just got cut by a fifth. We call this savings deletion. Your money is still there, but its maritime purchasing power is evaporating. The 8.4% import-induced inflation rate we're seeing, that's the $12 trillion insurance trap hitting the retail shelf. It's a quiet, invisible tax that no politician had to vote on because the gray zone did the voting for them. We're living in a world of sovereign escort convoys where the price of your life is dictated by the cost of a sovereign guarantee. It's the most significant shift in the global economy since the end of the gold standard, and it's happening right under our noses. The math is simple. Uninsurable oceans mean expensive lives. As the world's largest pension funds start pulling out of traditional maritime assets, you have to ask yourself, if they're worried about the exit, why aren't you? The ocean isn't just water anymore, it's a gated community. And your savings are the entry fee. Think about that next time you see a cargo ship on the horizon. It's not just carrying goods, it's carrying a price tag that's rewriting your future. If the world's largest fleets are now state-owned, what does that tell you about the future of your private wealth?